Context, joining us tonight is Manish Singh, the Chief Investment Officer at Crossbridge Capital. Manish, always a pleasure having you on the show. Thanks for making the time. But let me begin by talking about the interest rates, which have been rising quite dramatically in the United States. The dollar has become stronger against the Indian rupee and so many other currencies in the world. Do you see India becoming a less attractive investment destination because of what we are seeing in the US by way of its inflation numbers and the rise and the strength in the US dollar?
The short answer is no, because I think that when you're investing in India, it's not for the short term. You are investing more in the growth story, which remains intact despite what is happening in the markets around us. So the short answer is no. But just to add to what you mentioned already, we have seen the oil prices are back to where it was pre-invasion. So it's come all the way down from 123 to 92 or something, as I saw on my screen just now. So that's a good thing. To your point that you mentioned about interest rates, what we are seeing now, and we saw the record inflation number yesterday, but on the day that we had record US inflation, you saw the 10-year bond actually rally. So what's happening, yield is rising in the short term as market reprices some more hikes, but the long end is rallying, yields are falling. What it means is that the market is preparing for rate cuts next year. And you've seen, I think it was Nomura who came out and saying there'll be rate cuts beginning of June of next year. But if you look at the bond yield and the futures, they're pricing in 100 basis point rate cut between June next year and December 2024. That will be the steepest rate cut after a rate hiking cycle. So yes, the short-term increase that you are seeing is to combat inflation, but in no way means the rates are going to stay as high.
Manish, FIIs, they are anticipated to have sold over $29 billion in shares so far in fiscal 21-22. More than 80% of those sales occurred between October 21 and February 2022. So what's the thought process among foreign investors looking at India today? If growth in the Indian economy is not looking too bad, like you mentioned, compared to many other emerging markets, for the sheer strength perhaps that India has in domestic consumption, then why is the foreign investor not looking at India more favorably and investing more robustly here?
I would say that if you look at people who are investing for long term, and to that you will see private equity and venture funds, I mean, they are still committed positive. You know, they are raising capital. They are committed to locking in capital for long term. I was at a breakfast meeting just this morning with a couple of people from GIC, and they seem committed. So in my opinion, from what I have seen, people who are looking for medium to long-term investment, they see India as an attractive story, and for them, nothing has changed. As far as portfolio flows are concerned over short term into the liquid market, I mean, that just keeps chopping and changing because that's just down to how an individual portfolio has performed and what risk parameters they have in place and what drawdown they can take. But those can reverse very quickly. So if you really want to see India as an investment story or a growth story, then you have to look at longer term capital, whether they are committed. And from what I have seen and from my conversation, I don't see there has been any change in that. Of course, it would be good for India to, apart from everything that they are doing, to strike oil. And I'm not being flippant about it because I think that India has to have an energy story, independent energy story for the medium to long term. And I hope that the government is working on that because I think a part of me thinks that it's inconceivable that India does not have a fossil fuel supply. There must be plenty, which needs to be explored. India is a peninsula, as you know. There must be things onshore and offshore. And I hope the Indian government or somebody in the Indian government is looking into how to make India energy independent or have more energy locally. So giving incentive to businesses that can come and explore and work and create energy or find energy from within, I think will be very useful for India to be a strong story.
Well, talking about energy security, there is a big opportunity for India because crude prices have been on the decline and oil imports are one of our largest bills. They've been declining already at the prospect of restrained demand going ahead. The world's spinning into a slowdown. The question is, will other commodities lose sheen? Because today itself, we're seeing gold, silver, copper, wherever you look, platinum, all of these are going down. If gold continues on that downward trend, that import bill for India goes down too. Is that likely to help?
Yeah, I think it should. And you're rightly saying that, despite what you're seeing on the inflation front, if you look at the commodity story, the stock things are down 30-40%. You have seen the price of nickel, aluminum, and oil we've talked about. So at least the commodity story does not tell you that the inflation is sustainable. I think consumers are getting hit, and that will obviously mean that inflation will start coming down quickly whenever it starts reversing, and that'll be a good sign for India. So yes, on all those fronts that you have mentioned, which should come as a relief to everyone, and energy security and food security, it is something which is very vital. We are in a very difficult, globally speaking, I think that we are in a very difficult geopolitical situation, where you have on one end Russia, which has been challenged and will seek to have its dominance in sectors it can, but that also presents everyone with an opportunity. If you're having a cheap energy supply from Russia, which benefits India, that must continue, whether it comes from Russia or somewhere else from within. I mean, that should be the focus in India.
To us about the debt markets in the US. Surely there will be higher returns there for investments in debt. Won't that critically alter the course of emerging market equities?
Not necessarily. So if you compare yields, right? So we talked about the 10-year yield, as I was mentioning. I mean, the 10-year yield has gone down from 3.5 yield to 2.9%, despite interest rate rising in the short term. You're not going to get more than 2.5 or 3% on long duration bonds in the US. I think it's not happening, because if you look at where the federal fund rates are, and the futures are indicating that it should be at 3.5% in June next year, or it was indicating it should be 4.5%, it has come back in. It's inconceivable that federal fund rates are going to stabilize at 3.5 or 4%. I think that's just the US economy just cannot take it. People make the mistake of thinking 1970 central bank raised the rates to double digit, and it is for a brief period of time, and you cannot have those rates sustaining in the present circumstances, because the crucial difference is at that time the debt to GDP in the US was between 30 to 40%. It's over 100% now. So debt service cost is going to be huge, and it's the same thing that's happening in Europe, which is why nobody believes that ECB can raise rates in current environment, and euro has hit parity with dollar and probably heading lower. So debt is a big part, and that is just there. Most of the Western economy are there, and they have high debt level ratios, and they're just going to sustain it, and therefore interest rate has a natural cap in terms of where it can be.
And Manish, for Indian IT companies, the US contributes a substantial part of their revenues. A recession or perhaps even a slowdown is going to impact the revenues of the Indian IT sector. It's going to put jobs there at risk. Do you believe that could happen?
I think to a smaller extent, because again, even though we're talking about that there could be an imminent recession in the US, and maybe we already are in a technical recession, because remember the Q1 GDP was minus 1.6% in the US. US doesn't have to grow at a clip of India, right? Because they're 10 times bigger economy. So if they grow at 2.5 or 3% once they become out of this, that's still a substantial amount in dollar terms for Indian IT companies to be serving to. And this is where the size of the economy makes a difference. And when India grows at 10%, it's different than US grows at 1%. It's the same amount in dollar terms if you look at the size of the economy. So it's substantial. I'm not concerned immediately. Of course, you have seen even companies like Google and they're saying that they're not going to hire much in the US. So there will be some amount of slowdown. And I think it's just prudent to look at your costs. But I'm not concerned about that over medium term. It will be a big factor for Indian IT companies. And I think they'll continue to make money.
Manish, we leave it there. Of course, we're talking about the impact of rising inflation in the
Vikram.
US, and absolutely, we're talking